Good morning, everyone. We start off the day with the return of the so-called meme stocks. It's meme stock mania out there. GameStop shares soared as much as 83% in pre-market trading after more than doubling on Wednesday. And the resurgence spread to a number of other meme stocks at the center of last month's frenzy. Here to discuss is Bloomberg's markets reporter, Kriti Gupta, right here in New York. Hey, Kriti, thanks so much for being here. Why is this happening?
That's everyone's question. You'd really think that after the saga we saw last month, they really kind of calmed down. The retail trading frenzy wouldn't shake markets as much. But Tim, as you just said, we were completely wrong. We are really seeing the power of the retail trader just amplify after getting so much attention last week and really showing that they actually are making quite the impact.
Okay, so how is this playing out in WallStreetBets, and what happened with WallStreetBets, the subreddit on Reddit that got so much attention and that has grown so much over the past few months as retail traders have talked about these so-called meme stocks?
Well, it's gathered even more attention. Like I said, when you see how much just power and how much impact everyday people trading on Robinhood accounts and other online brokerages can really have on the broader market, something that was considered very elite and elusive, that really creates an impact and funnels a lot of attention to things like Reddit. So when you saw the Reddit site actually go down because of some technical issues yesterday, it was more than noticeable. It actually moved the market, Tim.
It did. I'm wondering if this is different than what we saw a few weeks ago with the so-called short squeeze and the way that these I call them activist investors. They're not. These retail investors were going after the hedge funds and trying to squeeze them out of their positions.
I think what's interesting is the crowd behind each of these names. You're no longer seeing institutional investors, your classic hedge funds, your classic kind of big money players anymore, entering stocks that are well associated and well known, things like GameStop, things like AMC Entertainment. There seems to be a very clear division on who's actually moving the market. And you saw that happen yesterday, Tim, that monster move in GameStop, really driven once again by the retail crowd, not so much the bigger players on Wall Street.
Do we know what prompted this? And initially the sort of narrative was, oh, well, an executive is leaving the company, but that was announced hours before this stock actually started moving significantly. GameStop, I'm talking about. What set it off yesterday, late in the day on the trading day?
Well, I think that just speaks, the timing of that really speaks to who's behind the move. When you see the stock initially react to a headline like that, it's usually kind of automated systems. It's usually people, pros who have the information at that very second, who are primed to act and therefore move the market. The fact that there was a delayed reaction really showed you that it kind of gathered momentum before that move happened. How do you gather momentum nowadays in the retail world? You coordinate it on social media, and that's exactly how it played out yesterday.
So how does this play out in the long term? Who ends up winning here?
That's the question of the day. We've never seen anything like this happen in American markets. We've seen it happen abroad in Chinese markets, and it kind of seems like the new reality will simply be people entering the market, increasing these bouts of volatility in certain stocks, things like GameStop. This is probably not the last thing you're going to hear from it, but then in other stocks as well. It's just kind of ebb and flow, and this is going to be a very permanent part of the way markets function from here on out.
So there's this really interesting statistic that our colleague Danny Berger shared. It's from a Deutsche Bank survey, and it talked about expectations for the market to be higher in 3 months based on different demographics like age and how much money people made. 64% of 25 to 34-year-olds believe that they expect the market to be higher in 3 months versus negative 15% of 55-year-olds who agree that it will be lower. What does this demographic trend tell us?
It's so interesting that the age difference is what's changing the market narrative. Now, Tim, I cover Wall Street all day, and what we hear from pros, from the veterans who've been in the markets forever, is they're waiting for some sort of massive sell-off to take place after the monster gains we saw in 2020. And yet, you're seeing the younger crowd, the people who are saying, well, we finally have access to the stock market, to this massive S&P 500, able to actually move the markets. They're the ones that are more optimistic about it. So I think as we see more people get involved from the younger age group, you're going to start seeing, once again, potentially higher gains in the stock market or potentially more volatility.
All right. Bloomberg Markets reporter Kriti Gupta. Hey, Kriti, thanks so much for your time. It's always good to see you right here on Quick Take.